After a nightmare on Wall Street in New York, it was a bloodbath on Dalal Street in Mumbai. India's stock markets crashing after US markets hit their lowest level in the last 8 months. India's stock market crashed in the morning following the slide in the Asian markets, which opened for trade before India. 4 lakh crore rupees were wiped off of investor wealth within just 5 minutes. In morning trading, by the end of the trading day, the Sensex had erased all the gains made by it in the year 2018 so far. 2 out of every 3 stocks at the Bombay Stock Exchange lost money for investors. The fall in IT or information technology companies and banking company stocks were the major contributors to Sensex's decline. A weakening rupee only soured the mood further on Dalal Street, the rupee continuing its fall against the US dollar, hitting a new low of 74 rupees 38 paise per dollar. As a result of strong demand for the American currency from importers amid unabated foreign fund outflows from India. So 4 lakh crore rupees, or 4 followed by 12 zeros. 4 lakh crore rupees of investor wealth was wiped off the Indian markets in just 5 minutes. The Indian stock markets took a nosedive early in the day. What were the reasons behind that crash? It all began with the US President Donald Trump's attack on the US Federal Reserve. Walking off Air Force One in Pennsylvania for a rally, Trump blasted the US Fed for hiking interest rates and causing a meltdown in the US stock markets.
No, I think the Fed is making a mistake. They're so tight. I think the Fed has gone crazy. So you could say that, well, that's a lot of safety, actually, and it is a lot of safety, and it gives you a lot of margin. But I think the Fed has gone crazy. Actually, it's a correction that we've been waiting for a long time. But I really disagree with what the Fed is doing.
The Fed, or the US Federal Reserve, has raised interest rates thrice this year and is largely expected to hike once again before the year end. Trump didn't stop there. The US president also took a dig at India. When asked by reporters at the Oval Office on whether India will invite sanctions for signing the S-400 deal with Russia, that could also be a major reason behind investor worries in India.
Last week, India signed an agreement with Russia to purchase S-400 missiles.
Yeah, I know they did.
$5.4 billion.
Yeah.
Would CAATSA sanctions apply to India, or are you planning to
India's going to find out, aren't they?
Are you planning to give them a waiver?
India will find out.
When?
You'll see. Sooner than you think.
And now we're being joined by Mr. Vijay Bambawani, market expert, who also runs www.bsplindia.com. Vijay, thank you so much for taking time out to be with us. From what I understand, it began the global sell-off. It's been across the board, not just India, Asia, Europe. Everybody's been a bad day of trade. It's been a bloodbath all over the world. In fact, it all began with the US. But if anything began before the US stock markets, it is Donald Trump and his rhetoric against the US Federal Reserve.
Good evening, Krishna. Thank you for having me on your show. You hit the nail on the head. The markets were trading fairly nervously as they were, and President Donald Trump merely added fat to the fire. Now, threatening India with sanctions and in no uncertain terms stating that India will find out sooner rather than later merely added the cat to the proverbial pigeons. And let's not forget that as markets get closer to the weekend, the sense of nervousness tends to accelerate because of the 2-day holiday ahead. So I know tomorrow's the weekend session, but I guess the markets just couldn't bear the combined weight of negativity that was dominantly present in the market sentiments.
But Vijay, if those investing in stock markets are watching us, what would be your advice to them in this kind of an environment? These are highly volatile times, and global geopolitics is impacting Dalal Street in India, stock markets in India, on a daily basis. You're
absolutely right, Krishna. This is if at all, this is the first time you're witnessing this kind of volatility in the markets. You're cutting your teeth in the markets, unfortunately, at a very, very challenging juncture. But for those who've seen it before, the 2000 Y2K crash, the 2008 decline, prior to this, the 1997 Southeast Asia currency crisis, I assure you, this is a part and parcel of the market. This is a once in a 8 to 10 year phenomena which occurs unfailingly and cyclically. So don't be surprised if the markets do have an extended decline. This is just the way asset prices tend to cool off after a spectacular run-up that you've seen in the last 30 months or so. But like I said, it's going to be extremely painful for those who are holding long positions. You're going to see a mark-to-market erosion in your portfolio values.
And if I were to ask you, after a crash and a sell-off like this, is it a good time for those waiting to enter the market, or should they be still on wait-and-watch mode?
I've always favored deploying my money in staggered bits and pieces rather than trying to take a big bite off the burger, as it were. So I'm in no hurry to buy, although I do feel that there are a lot of opportunities out there presenting themselves now that the market has come down. But I would kind of split my capital into 5 parts and maybe deploy 1 part out of that 5 tomorrow morning.
Right, and what about tomorrow morning? Then, if I were to ask you, after a day like this, I mean, how do you see U.S. markets witnessing a sharp recovery overnight, and that rubbing off on Asian markets, and then eventually Indian markets?
Well, Krishna, let's not forget tomorrow's a weekend session. So no matter what you see initially in the opening part of the session, my gut feeling is the last 60 to 90 minutes are going to be riddled with cautiousness, if not nervousness altogether. So I think any kind of aggressive bottom fishing, etc., can be ruled out tomorrow. This would be a buy opportunity for the extremely long-term investors who are, like I said, deploying maybe 15, maybe 20% of their allocations at this point in time.